Well, Zero Hedge has a very interesting article out at the top of the page if you check right now. I don't know how long it'll be up there. Apparently they're planning a subsequent article going more into this topic. But the headline is that the liquidity tsunami from the U.S. Treasury Department is over. And what they mean by that is that something actually that I had talked about back in October, November last year was that the U.S. Treasury had built up this huge balance in their checking account at the Federal Reserve. It was about $1.7 trillion. And I remember somebody had pointed out on Twitter, and again, this doesn't sound like a very reliable source, but a smart guy that I respect on Twitter, who works in politics in D.C. and other places, theorized that Trump essentially Trump had this card in his back pocket that he could play that was the massive balance in the Treasury General account, and that through executive order, if he really wanted, as an October surprise, he could just mail out a bunch of stimulus checks and spend that $1.7 trillion and create a bunch of free money for people. But lo and behold, the election came and went, and Donald Trump and Steve Mnuchin didn't touch that money. They just sort of, they built up that nest egg and they just sat on it. Well, then here comes old Janet Yellen, and she gets into office and she says, you know what? I think we're going to spend about $1 trillion out of that $1.7 trillion. 929 trillion to be exact is what they planned on spending. And what this means is that the Treasury was able to increase government spending by almost $1 trillion in the first quarter, I believe, is when they were planning on spending this much. So just in 3 months, they were going to spend $1 trillion in 3 months that would not have to be paid for by taxes or by debt. And so this truly was a liquidity tsunami. It was, it didn't have to come out of the private sector in any sense. And so, this would kind of explain, a certain extent, not just the mania, the acceleration of the mania in stocks and in real estate, but also, the shortages that we've seen, which seem to have gotten worse in 2021 than they were in 2020. Of course, lumber being the one that people talk about the most. But asset prices and prices in general, because again, when the government's spending money, it's not productive. It's just going out there and buying things and putting money in people's hands, and they're going out and spending it. And this creates an economic sugar rush. On paper, it looks like, oh my gosh, people are spending so much money. We had 6.4% growth in Q1 of this year. But it turns out that Yellen did not hit that $929 billion target. She did not spend anywhere near $1 trillion out of the Treasury General account. Now, she did spend as much money as they said, but they were paid for more of it with debt than, by issuing bonds than they were expecting, or than they forecasted they would. They didn't take as much out of their checking account. They only spent about $607 billion, according to Zero Hedge. Now, as of now, over the next month, the Treasury only plans to spend about $2 billion, or $1 billion, or I'm sorry, 100. I forget how many zeros there are on these numbers. $100 billion between now and the end of June. And so what does that mean? It means that in Q1, the Treasury was injecting liquidity into the economy at a rate of $200 billion a month, versus what the Fed was doing, which still sounds insane and massive. It's what I would describe as a liquidity tsunami, $120 billion per month. So the Treasury was injecting way more money on, net into the economy than the Fed was. Because remember, this is money that the Treasury has in their bank account. It's not money that they had to go to the Fed and have the Fed print for them. The Fed printed it for them a long time ago, and this is savings that the Treasury had built up. So what does it mean now that this rate of injections of liquidity from the U.S. Treasury is slowing down? Apparently, they only plan to be injecting at a rate of, like I said, throughout the next month in June, or actually no, between now and June. I believe they only expect to inject about 100 billion more. But it gets worse. In all of Q3, which runs from the end of June to the end of September, I believe, they're only going to spend another 50 billion total in that entire quarter, those 3 months. And what is that rate of like 18 billion or so a quarter? I mean, it's chicken feed. So this huge liquidity injection that we've seen in Q1 that produced this, Chinese-style 6.4% GDP growth rate is going away. And so does that mean that the government's going to cut spending? I doubt that, because I think that Congress and the White House know that they can't cut spending, because that's all that, that's the only reason why we had, on paper, a 6.4% growth rate. It's also, of course, the reason why the price of everything is going to the moon, because we don't have a real economy. The government is just spending money and consuming things. And so, at the end of the day, what the Treasury is telling us, if they are forecasting correctly, because again, at the beginning of the year, they they overestimated how much money they would be spending out of the Treasury General account. They spent less than 2/3 of what they actually, no, I think it was exactly 2/3 of what they planned to spend in Q1. They only spent 607 billion out of the Treasury General account rather than 929 billion. I'm mixing up my trillions and my billions, but I hope you're following this. Because if the federal government continues to spend trying to prop up this economy at the rate that they did in Q1, but the Treasury Department is no longer spending all this money. It is not going to finance 600 billion of it out of the Treasury General account, but rather is only going to finance another by the end of September, 150 billion total. That's equivalent to about that's just over what the Fed does in 1 month, and the 120 billion that is being injected by the Fed in liquidity into the markets, into the bond market every month is insufficient. The addict, in this case, the U.S. economy, the U.S. financial markets, they've built up a resistance to money. 120 billion, that's taking a hit of that's like aspirin to them. They can't even feel it. The old monetary heroin that the Fed has been peddling for years now just doesn't cut anymore. They need monetary fentanyl, and not just those little patches that you take. They need it injected directly into their veins. That's what it's like when the Treasury spends 607 billion out of the Treasury General account. That is money coming out of thin air. It is almost as good, and I use good in sort of in scare quotes, as if the Fed printed that money themselves. So the two options that I keep getting caught up and not getting to this. The two options that we have moving forward here, from now until the end of September, is either government spending is going to plummet radically compared to the first quarter of this year, in which case there would be significant economic repercussions, because the mega super ultra dead cat bounce bubble of the last year, since the bubble, the new bubble that's been inflated since March of 2020, that will begin to deflate very quickly, and it will be violent. Now, the good news about that is that all this inflation stuff I've been talking about will not be as bad. It'll probably still happen, but not in an apocalyptic sense, not to the point to where interest rates shoot to the moon because of inflation. But the end result will be the same, because if the government just kept spending all this money into the economy at the rate in which they were doing in the first quarter, and they continued this throughout the entire year, the rising interest rates being pushed up by the inflation premium would destroy the asset market. It would make bonds. It would destroy the bond market first, and then that would ripple throughout the stock market and the real estate market. That would be the end result of the government continuing to do what it's doing, just injecting liquidity at the current rate into the market. But if they slow down, let's say, just for argument's sake, I don't think this is going to happen, that in order to make up for the lack of money that's being injected from the Treasury General account, they don't go into the bond market and borrow that. That the federal government just says, no, we're going to spend less overall. We're only going to borrow money at the same rate that we did in the first quarter of this year. If they were to do that, asset markets would still plummet, but not because of rising interest rates. You wouldn't need to raise interest rates to kill the asset markets. They would, like I said, they're numb to this, or numb's not really the right term. The drugs just the drugs that they're getting from the Fed is not enough to make a difference. They're going to come down off that high. And so things will get ugly very quickly. And that's why I don't see that happening. I don't see this president and this Congress and this Fed allowing that, or this Treasury Department, allowing that to happen. So what's most likely going to happen is that either Yellen is lying through her teeth and she is going to spend the rest of the money out of the Treasury General account, in which case, she can only do that until they get down to zero. And she continues the liquidity injections from the first quarter until the Treasury General account is emptied sometime at the end of this year. If they continue the rate of liquidity injection of $200 billion a month from the first quarter, that'll be gone quick. Remember, there was only $1.7 trillion in there to begin with, so that means that in 9 months, at $200 billion a month, you're done. But if Yellen keeps her word and doesn't spend the money out of the Treasury General account, but the federal government continues to spend, just like they did in Q1, the Treasury Department will just go into the bond market and borrow more money than they have been thus far. So I hope you're still following here. I realize this is a convoluted situation. If the Treasury goes in and they spend as much money as they did in Q1, but they don't spend as much out of their checking account, they borrow more, that money has to come from the bond market. And the Fed supposedly is not going to be increasing bond purchases, so the Fed's only dumping $120 billion a month into the bond market. So whatever the Treasury decides to spend, the first $120 billion is paid for by the Fed, and after that, it has to come out of the private sector. And so if the Treasury is borrowing more money out of the bond market, but the Fed does not increase its bond purchases, interest rates must rise. And the reason for this is that the supply of bonds is going to increase on the market, and therefore the price must fall. This is basic supply and demand. Yellen's spending of that $600 billion or so out of the Treasury General account had an equivalent effect on the U.S. economy to that of a stock buyback on the stock price of a company. And when a company just borrows money to buy back its own stock, to drive up the price, and that's the reason why the price of the stock is rising, if that company gets to the point where they can't afford to keep buying back their own stock, well, then demand for that stock is going to collapse, and the price is going to go down. And that's exactly what it looks like the U.S. economy is being set up for right now. Because again, if the Treasury has to go in and borrow a lot more money, and the Fed is not sucking out any more of those bonds out of the market, the price of bonds, the value of those bonds, is going to decrease. The interest rate will rise, and that will ripple throughout the rest of the U.S. economy. And so, what I've been watching for, what I keep stressing on this channel, is that throughout all of the ups and downs and the different things that you hear about the economy, what you need to always pay attention to is interest rates. And that if interest rates stay low, the bubble continues to inflate. If interest rates begin to rise, and that rise looks like it's going to be sustained and it's going to continue, then the bubble will pop. That's what happens every single time. And it looks like right now that all the news I'm seeing, no matter what, I'm seeing news that's saying a lot of different things. I'm seeing news that suggests we're getting more liquidity, news that suggests we're getting less liquidity, but all roads appear to lead to higher interest rates. Now, I don't know how much, as a result of these varying different scenarios, how much interest rates will rise. But these are all, in a sense, stories that are bullish for interest rates and bearish for the bond market. And nobody wants to be bearish on the bond market because unless you don't own anything, which would be most of us here in America if you don't own assets, because you would probably like to buy assets at some point. You would like to invest in, I don't know, stocks or bonds or something, so that you can, you can plan for your retirement or just make money in general, or buy a home so you could live. And the only way that those assets are going to become affordable is through higher interest rates. So, what's the most likely scenario to take away from all this? Well, in order to understand that, we have to discuss the psychology of the Fed. And I know today is mostly about the Treasury, but the Fed is always at the core of every issue. Really everything in politics, when it comes to war or the economy, or even social values and things, that all comes down to the Fed. I mean, the Fed is all in with woke capital, and they empower those people. You would not have these massive multinational corporations without the Fed. But that's a story for another day. So the rumor right now, according to Zero Hedge, is that the Fed is going to announce in June, at the June FOMC meeting, that they're going to taper QE, just as the last of the, just as the fire hose of liquidity from the U.S. Treasury Department is being, shut off at the hydrant. And so therefore, people are thinking, oh my gosh, it's going to be so bearish for bonds. Because bonds there's going to be all these bonds being dumped into the market, and the liquidity is getting sucked out. First the Treasury, and now the Fed is going to start pulling liquidity out of the market, and that will drive up interest rates. Well, frankly, I just don't see that happening. Powell has said, before that it's not even time to thinking about raising interest rates. And so we know that he'll never do that. But tapering QE is one step removed from raising interest rates. It is an implicit raising of interest rates, because if the Fed tapers QE, interest rates will rise. But if Powell's saying it's not even time to start thinking about raising interest rates, well then why would he taper QE? Because that's exactly what he would be doing. He would be doing so much more than thinking about raising interest rates. He would actually be raising interest rates. So why would anyone think that Powell's going to taper QE? At the very least, or at the very most, he'll keep QE the same. But if, because the Treasury is slowing down this liquidity injection and they go into the bond market and they start borrowing more, if that starts to push up interest rates, I think the Fed is going to increase QE. In other words, the lack of liquidity injections from the Treasury will be made up for by the Fed to a certain extent, to the extent that Powell deems it necessary. And to what extent? Will he deem that necessary? Well, he'll deem it necessary to the extent that it is required to maintain interest rates at their current low levels. And so that means more liquidity injections and more of the federal government, just pissing away money into the so-called economy to artificially boost GDP and make it seem like everything is normal and dandy when things are far from it. And so I do not see the authorities, the Fed, the Treasury, Congress, allowing this bubble to just unwind, or even begin to unwind the way it happened in 2008. I think they all feel like we don't ever want that to happen again, and so they are going to kick the can down the road for as long as they can. And so that, again, we're back to what I was talking about a couple days ago, or was it even yesterday? I mean, this has been at the top of my mind, as you can probably tell. The Fed is going down the inflationary path. So is the Treasury. They're going to print until they can print no more. And printing money comes with, diminishing returns. Even the MMTers, the modern monetary theorists, they admit this. They say, well, yeah, you can print as much money as you want until it starts to, until inflation becomes a problem, and then, of course, there's diminishing returns. The more money you print, you actually start to have an inverse relationship, or a positive relationship with interest rates. Normally, printing money has an inverse relationship with interest rates, and that if the more money you print, the lower interest rates get. Well, at a certain point, you print so much, interest rates are going to start going back the other way anyway, and the only way to get interest rates back down is if you is if you actually withdraw liquidity. You start pulling money out of the system and reducing the money supply, which in the short term manifests itself in extremely high interest rates of 22% back in 1980. But that was what was needed in order to get things back down to normal. But this Fed does not understand that. They don't care. They have no respect for Paul Volcker. To them, the great genius was the maestro, Alan Greenspan, and he was a very smart guy, still is a very smart guy. I tend to agree with Alan Greenspan when he's just giving his opinion on the economy. He sounds very similar to me. We're of the same academic background, other than the Randian stuff. I was never into Ayn Rand. I thought she was a cultist, and that Greenspan is a part of her cult, but that's different. That's philosophy, and I'm talking about economics here. But the point is that Greenspan always tried to keep the bubble going. Because he understood that he could do it in such a way that, he could go his entire career without having a major recession. But you can't just continue playing the Greenspan playbook forever, because you're going to hit a wall eventually, and that's really where Powell is heading. If he enables the federal government to continue inflating the economy in the manner in which they did in Q1, and this continues in perpetuity, which is what you're going to have to do in order to keep the GDP numbers on paper alive, in order to maintain the U.S.'s pulse, because things have to get much worse before they get better from a productive standpoint. The economy is producing less and less. That's why we are experiencing shortages. We are consuming more than we are producing because the government answer to their ridiculous lockdowns that decimated the productive sector of our, productive portion of our economy was just to let people consume more and to replace production with consumption, which, violates, Say's law, which is undying. And, no matter how much he's slandered by Keynesians, Say was correct in saying that production must precede consumption. You can't consume more than is produced. But that's the magic trick that our government is trying to pull off right now. So that's where we stand. The rest of this year is going to be pivotal. By the end of, well, I guess maybe even by the end of Q3, considering how little the Treasury plans to draw on the Treasury General account, we should know which direction things are moving. Either, we have, I believe it's 3 choices here. Option number 1, the federal government spends less money and still borrows the same amount of money from the private sector, and so there's there's no spike in the supply of bonds, and therefore the economy begins to deflate because of the lack of government spending, which cannot be made up for by the private sector because the private sector has been decimated over the past year. Option number 2 is that the Fed steps in and replaces that liquidity that was being injected by the Treasury from the Treasury General account by printing it themselves. This, of course, will lead to inflation, which will eventually push up interest rates, which then will kill the economy. And then the final option is that the government continues to spend as it did in Q1, but the Fed does nothing and just continues its $120 billion in liquidity injections per month, in which case the supply of bonds is going to balloon. There's going to be this huge surge in bond issuance, and which should push up interest rates and kill the asset market and kill the broader economy, which again is already dead. This is a dead economy walking. I thought we were in rough shape under Trump. Boy, did I! If you had, left a comment from the few, if you as a time traveler went back a couple years ago and posted something about how bad things were going to get in my comment section, I would have never believed you. Because I used to talk a lot about clown markets. We're well past clown markets. I mean, these are post-reality markets. These are markets in the Matrix. And it ultimately will have to come crashing down once the bond traders unplug the Matrix cables from the back of their heads. And ultimately, I see that as the most likely scenario. The bond market will save us all. Of course, they will be blamed for our destruction by lemmings who have no understanding of capitalism or of the very corrupt financial system under which we currently live. So with that said, I think that I have sufficiently explained the additional information and integrated that into my my running theory about where we're going. Like I said, we should know by the end of Q3, because the Treasury plans to spend so little out of the Treasury General account, only $50 billion over 3 months. That is a drop in the bucket. It's nothing. So we will know which of the 3 scenarios discussed today, which of the 3 paths we're going to walk down.